Today, we are talking about how to pass wealth to the next generation in a way that is smart, simple, and tax efficient here in Canada. One key way to pass on wealth tax-free in retirement is if you have excess cash flow in a corporation, this is a way to get those assets out tax-free. If one of your goals is to maximize your legacy to the next generation, if you just want to leave a legacy without handing half of it to the CRA, this episode is for you. Hello and welcome back to another episode of Your Retirement Planning Simplified. I'm your host, Joe Curry. And today we are talking about how to pass wealth to the next generation in a way that is smart, simple, and tax efficient here in Canada. So, whether you've built a solid nest egg through saving, you've sold a business, whatever your reason, if you just want to leave a legacy without handing half of it to the CRA, this episode is for you. So, today I have 7 tax smart ways to leave a legacy without leaving a tax bill. So number 1, and this is one a lot of people I think maybe strive for, but if we're being real, it's not going to happen. But lottery winnings. Okay, so something a little fun. In Canada, lottery winnings are completely tax-free. So I love to point that out because again, this is not something that is realistic, but people love the idea of a lottery, love the idea of not paying tax. So this is one of the very few ways we have of making money without paying tax. So if that works for you, that's great. But if not, let's move on to some that you might actually be able to utilize. So number 2 is the principal residence. So the home that you own, the home that you live in, you do not pay tax when you sell this, no matter how much that has grown in value since you bought it. And so this is a way to pass on wealth to the next generation without having to pay any tax on your estate. Now, that doesn't mean that you should never sell it while you're living. There might be reasons to sell it. It might just not be feasible to keep it. There might be other options available for you that meet your lifestyle needs better, like a retirement residence or just downsizing, maybe a condo. So there's lots of reasons why you might not keep this. But, as long as you're living in it, as long as the housing market goes up in value, which we know doesn't always happen, but it has for the most part, all that growth is tax-free. And if you are in your house, you're still in your house when you pass away, that's going to your estate and there's going to be no tax paid on that when your kids, your beneficiaries sell that asset. So that is one key way to pass on wealth tax-free in retirement. I'll also just add to that, this is one of the arguments I would make for, owning a house. But the flip side of this is we have talked to a lot of clients recently trying to weigh the option of, do I sell to be more flexible in retirement and rent? And there's a lot of stigma around renting versus owning something. So I do want to just have the caveat out there that in a lot of cases, financially, it's not better to own. But from that tax advantage, there's definitely something there for passing on wealth to the next generation tax-free. So moving on here, we'll look at the tax-free savings account. Now, when the tax-free savings account first came out, it really wasn't something to get too excited about. It was nice to have this account where you could get a little bit of growth tax-free, but it didn't amount to much at $5,000. But now, as that value has risen to what you can contribute to, over $100,000, it's pretty significant. And if you've been doing this all along, you might have $150,000 or more in there if you've been investing that money. So this is a pretty significant piece of your portfolio, most likely. And everything that's growing in there is tax-free. So the growth is tax-free, so no capital gains. Any interest paid off of things like bonds or GICs, tax-free. Any dividends that are paid out, tax-free. So that's all accumulating tax-free. So we definitely want to take advantage of that. But the other thing is, one of the reasons we may not want to spend money to that tax-free savings account if we have other resources for retirement is because when you pass away, if you have a spouse, first is just going to roll over to the other spouse and actually enhance the size of their tax-free savings account because you can combine those. But when the survivor passes away, or if you're single and you pass away, your beneficiaries are going to get all that money tax-free. And you can put a named beneficiary right on there, and that'll bypass the estate. You don't pay probate directly to your beneficiaries. And again, no tax on those assets. So the tax-free savings account is one of the best ways we can pass on wealth tax-free to the next generation or whoever you want to leave that money to. So continuing on, much like a continuation of a tax-free savings account is this next asset class. And now I'm not one for pushing life insurance to, think of life insurance as an investment. That's not really an approach that we take. We think there's probably better options for creating income in your retirement, right? But that said, if we think about the way I just explained a tax-free savings account, you can put money in there. So say right now we're putting $7,000 a year in there. You can think of that like a premium. You're paying a premium of $7,000 a year into that tax-free savings account. That tax-free savings account is then growing tax-free. And when you pass away, that entire tax-free savings account is going to the next generation tax-free. Well, if you have additional resources, additional income or money available to you that you don't need, you're not going to use it in this lifetime, you could extend that tax-free savings account by taking that money and putting it into a life insurance policy, a permanent, most likely whole life, possibly universal life insurance policy or life insurance policy. And so why you might do this is not because you need the insurance, okay? If you're about to retire, you're listening to this podcast, you probably don't need insurance. There's a good chance you don't have a mortgage anymore. There's a good chance that your kids, they don't rely on your income anymore. So some of those key reasons why we have term insurance while we're still working and we have a young family, they've gone away. So now we're not thinking of insurance as a need. We're thinking of this as, we've built up this nest egg, we've built up this wealth. We're probably not going to spend it all in our lifetime. And we don't want CRA taking a big chunk of it. So what can we do with it? So again, tax-free savings account first for sure. But we still have those additional resources. This is when we might think about putting money into a life insurance policy that gives us a guaranteed rate of return. So right off the bat, if say you're putting $10,000 a year into this policy, that might give you $250,000 of insurance. And I'm just making up numbers here. Don't hold me to that. But let's say, so $10,000, immediately you get $250,000 of insurance. If, God forbid, you pass away tomorrow, it pays out tax-free to the next generation. But ideally, that's, you have another 20, 30 years of retirement. So that will just continue to grow. You continue to fund it. It will continue to grow. And when you pass away, again, going to the next generation, tax-free. So all the contributions you put in there are going to have a positive rate of return, which is going to be enhanced by the fact that it's all tax-free when it gets paid out. Okay. So like I said, it's very similar to a tax-free savings account when we're thinking of it as a wealth transfer vehicle. Probably not the place to start, but it does give us tax-free wealth transfer. So the next place I'm going to go is kind of an add-on to one of the benefits of life insurance if you're a business owner. So the Capital Dividend Account is kind of like a business owner's secret weapon against tax. And so basically, an example here, we're just talking to a client the other day about this actually. They've have a holding company. They've got some rental real estate in that holding company. Not a ton of cash, creates income. So there's income there as they need it and more than they need for retirement. But it's not sitting with, millions of dollars of cash or investments in there. And so what will potentially happen, and there's some other planning that can be done to mitigate some of these taxes, but you can't get around all of them. But the way that it exists today is there's this holding company. So imagine you have a holding company. You've built up, let's call it $10 million. And I might be exaggerating on your situation. Maybe I'm not, but just as an example, let's say you have $10 million. You've built the value of all the assets inside that holding company. Now, when you pass away, that's a capital gain. So your estate needs to pay income tax on that capital gain. So that's a gain of $10 million. $5 million goes into your income and a little bit over half of that, but we'll call it $2.5 million your estate in this example has of tax to be paid. $2.5 million of tax to be paid. Now, if you have rental real estate in there, you might think, well, they can just sell some buildings, take the money out, and then that's how they can pay for the taxes. Well, if we think about that for a second, you may not want them to be forced to sell some of that real estate you've built up in there because the worst time to sell something is usually when you have to sell it. But forget about that again for a second. Let's just say you sell $1 million property. Well, the kids have to take that out of the corporation to pay the tax. And now half of that tax or half of that amount is going to go to tax. So you sell $1 million, you take $1 million out, you pay another $500,000. So $1 million of cash from the holding company really only gets you $500,000 to pay tax. So again, there's some other planning we can do with your accountants to get around some of that tax. But at the end of the day, owning a holding company could have significant tax disadvantages But if you own a life insurance policy, essentially the way it works is the holding company owns the policy. The holding company pays the premiums. The holding company would be the beneficiary of the policy. And then when you pass away, because you're the life insured, the holdco receives that death benefit, receives those proceeds. And then the majority of those proceeds now can actually be paid out through the capital dividend account that I mentioned earlier to the beneficiaries on a tax-free basis. So again, this isn't for everybody, but if you have excess cash flow in a corporation and you know you're going to want to get some assets out of that corporation that are otherwise going to be taxable, this is a way to get those assets out tax-free, right? So I'm giving you high level. There's other nuances and things that will come in to play based on your situation. Again, why planning is so important. But it is a tool for a business owner to pass on some of those business assets tax-free to the next generation. And at the very least, help pay some taxes if there's going to be some there. All right, number 6, we're going to look at strategic withdrawals from your RRSP or your RRIF. Recently did another video on this. And this is why, withdrawal planning, retirement income planning is not a one and done. You don't use a rule of thumb. Every situation is different. But if one of your goals is to maximize your legacy to the next generation, this isn't a tax-free vehicle, but it's a tax-free consideration or action you could take. It may make sense to be taking more money out of your RSPs or more money out of your RRIF than you actually need, depending on your tax bracket. Because when you pass away, a lot of people don't realize they're going to get a big surprise tax bill, or I should say their estate's going to get a big surprise tax bill, because whatever's left in your RRIF when you pass away, there's a good chance up to 50% of that is going to go to CRA instead of your beneficiaries. So if we can plan throughout your retirement how we might be able to move some money out of those RRIFs or RSPs over into tax-free savings accounts or even non-registered accounts, or maybe even into a life insurance policy, that's going to help eliminate some of that tax that would otherwise happen on those registered accounts and put your money or your assets into a position to be transferred in a more tax-efficient way to your beneficiaries when you pass away. So again, that's not like a tax-free move, but it is an opportunity to reduce your lifetime taxes and make your wealth transfer more efficient. Okay. And finally, number 7. So this is the living legacy, right? So while you're living, we always think about how are we doing this wealth generation or this wealth transfer to the next generation on a tax efficient or even a tax-free basis. But sometimes when we think about it, by the time we pass away, our kids might not need the money anymore. In fact, they may have already built up their own nest egg and be doing the same planning that you're thinking about right now. And when the time that they really need it might be now, or it might be early in your retirement, right? While they still have young kids, they're trying to pay for sports. I speak from experience here, trying to pay for different sports, different activities, still have a mortgage. There's a lot happening and, there's a big drain on your resources at this point earlier in life when you have that young family. And again, you're trying to build up your own nest egg. So you can gift cash to your kids, to your grandkids, tax-free. They don't have to pay tax on that. So that might be another consideration for you. So again, if you have income coming in that you don't require, tax-free savings account, life insurance policy, these are great things to get money to the next generation tax-free. But, don't hesitate to give some money, and your kids, your grandkids better than anyone else. So, if it's not a good fit to give them additional money, you have to make those decisions. But if you think they could use that money now and there's going to be no, adverse effects of gifting that money, that's something you may want to consider today because you can do that tax-free. So this could be helping your kids with things like down payments or paying off the mortgage quicker or tuition payments, other debt reduction, or maybe investing in helping them start a business. So there's a lot of other considerations other than just giving the money here. But again, these are things you could be helping with. All right, so let's do a quick recap on the 7 tax smart ways to pass wealth in Canada. Number 1, we had the lottery. If you can get the lottery and pass on those proceeds, that's tax-free. No, really, that's more tax-free to you. But again, it's awesome if you can do it, but be more realistic. Number 2, you have your principal residence exemption. Number 3, you have tax-free savings accounts. Number 4, you have life insurance. Number 5, you have life insurance inside a corporation to get assets tax-free out through the capital dividend account. We have RSP or RRIF planning, something we call strategic withdrawals. And we have giving a living legacy, right? So giving money while you're still alive, which those gifts of cash are tax-free to the next generation. So these are all powerful tools. Not all of them are for you, or maybe all of them are, but it really depends on your unique situation, right? So that's why it's important to have a plan that fits around your personal circumstances. And most importantly, thinks about your goals, right? Because depending on what your goals are, tax-free or tax-efficient wealth transfer as the main priority versus maximizing sustainable living or maximizing your lifestyle while you're retired, like those are going to have some different actions in how you're planning this out, right? So I gave you the recap of some of the strategies, but take a step back and think about how are you implementing these into your plan. If you'd like some help strategizing or building out a plan that encompasses these different strategies specifically for you, you check us out along with all our other retirement planning resources at retirementplanningsimplified.ca or our financial planning firm website, matthewsandassociates.ca. And until next time, happy planning.